have your exams, but the TAs wrote the grades on the front page. So if you don't mind that your grade is potentially seen by your classmates, then you can just come pick them up directly. I'll just lay them out on the table and you just find it. Otherwise, I'll pass them out one at a time. So what do you guys want? You guys don't mind seeing the grades of your classmates, then I mean, if you don't mind your classmates seeing your grade, then I'll just lay them out on the table and you find it. Otherwise, I have to pass it out one at a time. So anybody who mind, does anybody mind? Raise your hand if you mind. Okay, then I'm just gonna lay it out on the table and you guys come get your exams. Yeah, you guys can come get your exams right now. There is no order, it's random. So you got to look for it. Okay, so all exams have been taken, so I assume that nobody's taking anybody else's exam. But anyways, the grades have already been uploaded, and it's on Canvas. So just your job, just to make sure for your own sake, make sure the numbers add up, right? Because I believe the TAs wrote the points you receive for each question on the front page, and just make sure those numbers add up to the total number that you see on Canvas, because that's the one I'm going to use to calculate your final grade. All right, so let me give you some statistics on your performance. The mean was 72 out of 80. Standard deviation is 4, and median is 74. So despite everyone taking the full 3 hours, you did well on the exam. So I'm not sure people finished and just sat there for, I don't know, an hour. But anyways, well done. And if you look at the median score for each question, mostly everyone got everything right. Maybe the last question, I'll just maybe make sure everyone got that. But overall, I think everybody knows how to do currency arbitrage with forward contracts. Everybody knows how to do triangular arbitrage. You understand how to do short run, long run analysis, right? With those UIP and money market equilibrium equations. And so I'm convinced that everyone has fairly strong conceptual understanding, and I probably made the exam a little bit too easy. So you have to probably expect a little bit harder final exam, okay? Or even maybe just longer, all right? Maybe not just longer. Okay, I will go over the questions quickly because I think the questions are actually very, very straightforward. I just window dressed it with some context that maybe you are already aware of these events, news events that you read in the articles. I don't know what your news source is, but certainly I just take the front page of the Wall Street Journal that I read every day, and I just kind of think about some context to window dress the concepts you learned. And hopefully you saw through the context and you were able to, distill the prompt into, the framework we learned in this class. So expect the same for, the final exam. So anybody have, in general, comments, questions about the midterm? Anything specific about the midterm that I can answer now before I just go over the solutions? All right, so again, if there is an error in the grading, you have to contact the TAs that's on the syllabus. All right, and you have to arrange a meeting, and they have to look through your exam and just double check that their grading was correct or incorrect. I didn't grade it. I just double checked the numbers. I just double checked that the distribution looks good, and that's it. So you have to approach them to figure out exactly if there's a disagreement, you have to resolve it with them. So just check the syllabus. All right, so let me just really quickly go over the solutions. This is abridged, meaning I didn't go into full detail. I know many of you wrote like full essays, which was completely unnecessary. I was just looking for very quick bullet points, and if you got those bullet points, you should have got full credit. Okay. Maybe there was a slight misunderstanding, then you might got like -1, -2, something like that. All right, so Q1, I pulled directly from the slides and also the homework assignment. So if you are able to tell me how total savings defined, how total savings between private and government savings were different, and you can easily back out that current account can be expressed in a certain way, right? Namely, domestic savings minus investments, right? Sorry, total savings minus investments, which is this equation here. The second part of this question gives you some context about Chinese policy that kind of want to foster domestic production, right? So if you read the news, if you've been following the news, China has tried to foster their own medical equipment industry, and by doing one way to kind of generate development, R&D in this industry is to just force them to buy local, right? In America, in the US, you say buy American, right? In China, they can buy Chinese. So that's where the title of the question came from. So if Chinese companies were forced to buy Chinese, how does that impact the current account? And just your very basic understanding of the current account, you can easily kind of derive what should happen to the current account once this sort of policy is in place, right? If there is a policy that wants more people to buy more Chinese products, then obviously imports of various medical equipment inputs must be curtailed, right, or stopped. In that case, less imports, the current account should actually benefit as a result. Okay, so you should see trade volumes decrease because there's less import coming into China. Whether there's more import leaving China, that's another thing, another story. But so saying something that import volumes have been curtailed because of this policy, that's all you need to say. All right, so for question 2 is just a test if you understood how to write out an arbitrage strategy to exploit interest rate differentials while eliminating foreign exchange rate risk, right? Risk comes from 2 sources, right? The spot risk as well as the forward contract. So as long as you checked that CIP is violated, then you know which type of forward contract to take. So in this case, I believe you're supposed to, borrow foreign and invest domestic, right? Something like that. And so this is the payoff strategy. I mean, the arbitrage strategy that I outlined. I hope it's something similar that you wrote on your exam. All I'm basically checking is 2 things. You're checking that CIP is violated, and you write something like this, specifically that you get the forward contract correct. You're short forward. So I'm not going to walk through this. So just make sure that you agree. If you don't, then you come talk to me. All right. Question 3. If I remember correctly, question 3 is about the possibility that China experiences an economic contraction. So if you look at GDP growth, obviously China has been growing. It's consistent growth. It's the change in the growth rate that brings about news, that makes the news. And just recently, people think that maybe China's growth rate is going to either stall or even become negative. That's very big news. So we're just doing a thought experiment. If China indeed experiences a contraction in which real income decreases, what should you expect the effect on the spot rate, the spot exchange rate? And if we were to do this visually, which I asked you to do, what you should see is the liquidity preference curve shift towards the origin, right, inward. So the logic I've outlined here, so if you have L shifting towards the origin, representing Y decreasing, right, interest rates should decrease due to higher demand for savings, right? If you have less income, you want to save more, you don't want to consume as much, so there's going to be more demand for savings. So another way to say that, you're more likely to buy bonds, right? And that's going to push up the price of bonds and decrease interest rates, right? That's the mechanism here. All right. And when interest rates change, then there's going to be incentives for carry traders to come in to short domestic R because interest rates has gone down. So they borrow R and they invest in R star, and that's going to push up the value of foreign currencies, right? So E has to go up. All right, so that's the first part. The second part is, well, what if China decides to combat this hypothetical decrease in real income by expanding the real money supply? So if they decide to expand money supply, that's actually going to reduce R even further and devalue the domestic currency even further as well. So I think the last part of the question was, what's the total effect, or is it ambiguous? If you analyze these 2 separately, you see that it's all pushing E and R in the same direction. So as long as you say the total net effect must be positive for E and negative for R, then that's it, you're done. Okay. And long run analysis, if you read the prompt correctly, there's nothing talking about permanent anything, right? Nothing's permanent, and so there's no price effect, and there's ultimately everything's undone, right? So Y is only temporary, and so is monetary policy is only temporary, so no long run effects. So you wrote something along the lines that everything reverts or nothing changes from the starting point. That's good enough. All right. Comments, questions on Q3? All right, question four. Question four. Question four, the context that was given to you was about the United States fighting persistent inflation. So again, if you've been following the news, you can also think about this concern by the U.S. Central Bank within the framework you're working, right? So if the United States really wants to fight, I think 4%, 3 to 4% inflation, they can do as suggested by the prompt, a permanent decrease in the money supply, and that's going to have an impact on not only the real money supply, but also expectations about the future value of the spot rate, right? And so you do that analysis just like in the slides, right? But in the opposite direction. So there's going to be an overshoot and then a reversion, right? That's the kind of takeaway from that sort of analysis. So in the slides, you had a permanent monetary expansion, so you get an overshooting of the spot rate, and then a reversion back to a still elevated level, but still higher than before, right? But this is in the opposite direction. You get a significant decrease in E, so appreciation in domestic currency, but it's going to rise higher than the short run, right? So as long as you do the same analysis that you saw in the slides, right, but in the opposite direction, you should get full credit. So I think the key thing that the TAs were looking for is that you demonstrate that there is an overshooting, but in the other direction. Okay, question five. Question five, I think there are three equations you have to know, right? UIP, CIP, and the long-term condition, right? Absolute PPP condition is satisfied. So if you combine these three equations in certain ways, you should be able to draw conclusions in part 1, 2, and 3 of question 5. So they're all false. Okay, and I'm not giving you the reason here. You just figure it out. You should be able to figure out. I just said again, right? Assume CIP, UIP, and absolute PPP is true. You can draw all sorts of conclusions based on the numbers that's given to you. All right. Question 6. Question 6 is about the gold standard. So gold standard question assumes that prices are fully flexible. And so you can do this analysis. You can draw conclusions from this analysis by just looking at the real exchange rate, Q, right? Q equals EP star over P. So if you have foreign money supply increasing, then foreign prices have to increase. And as a result, Q has to increase based on this equation, right? Okay, so price specie flow mechanism is, well, if there is a shock or perturbation in the current account to a new level, that's going to create a reverse effect, right? Arising from prices arising from Switzerland's perspective. So if there is a sudden increase in Switzerland's current account, then what's going to happen is that the foreign prices are higher relative to domestic prices. Foreign country imports from domestic country, but then domestic country is going to start importing gold to substitute away from the more expensive prices. And when they do that, local prices will rise. And then based on the real exchange rate, Q has to decrease, right? Because higher denominator means lower Q, and that's going to revert the current account in the opposite direction. So if you just describe the mechanism that way, everything comes from prices. So price specie flow mechanism, it's in the name, right? It comes from the fluctuations in price levels that reverts everything back to normal. Okay, so if you wrote something that described that, then it's good enough. All right, comments, questions on Q6 on the international gold standard. So the key analysis, the key assumptions of Q6 analysis is that prices are fully flexible, right? I know compared to the analysis you did for the other questions, we kind of assume P is fixed, but for this question, when we do international gold standard, we assume prices are fully flexible. That's kind of that's what motivates gold flows, right?
when goods and services become cheaper elsewhere, you have to import gold to that place. Inflation that causes inflation, right? And blah blah blah. Okay. Q7. Q7 is just an exercise to show me that you know how to find triangular arbitrage. This is the solution. I mean, this is one of the solutions. As I said, there's 3 solutions. And as long as you find one of them, good job, right? If you got marked up points, you may have used the wrong quote, right? That's the trick here. When you do this triangle arbitrage, you have to decide to use the bid or ask. And when you do it, you just realize when you do it in reality, you're a price taker. You have to take whatever price is being offered to you by the market maker. You can't negotiate. You don't have the time to do it. You need to execute it instantaneously. And in that case, you always have to pay the higher price if you're buying and sell at the lower price if you're selling. Okay. So just double check again. If you got the path right, but you got lots of points, you probably used the wrong quote. All right. Lastly, Q8. What is question 8 about? Oh yeah. Question 8 is about changes in expectations, right? So you can also analyze news events, right? Not only hypothetical scenarios in which you actually change the money supply, but you can actually conduct analysis of news events, just run out expectations as if nothing has occurred, right? So in question 8, the only thing that changes is the UIP curve, right? Because I didn't say that money supply changed or anything changes, right? I only said that expectations about something changed. And so the only curve that shifts in this setting is just the UIP, because E hat E changes. Okay. And so because expectations change, short run things change as well as long run things change. Right. All right. Comments, questions on Q8. So again, the Q8 takeaway is that you can use the model, the framework that was presented to you for the last 6 weeks to analyze just changes in expectations, right? If people have different beliefs because the central bank announced they're going to do something in the future, but they haven't done it yet, E hat E will still change as long as it's new information. If it's not new information, then E hat E doesn't change. But you consider it as new information, then everything changes, right? It changes instantaneously. It also changes in the future, right? Because its long run expectations are different. No. So that's the exam. So actually, I think it's actually doable if you didn't have a cheat sheet or your notes in front of you. But in any case, I will still make the final exam open notes, open book. Roughly the same format, and yeah, still 3 hours. So there should be no surprises or when you see the format of the exam. Okay. So comments, questions on the midterm. So overall, everyone did well. But because everyone did so well, I have to make the final exam a little bit harder to kind of. It is unfortunate, I know. It's unfortunate, but this is when grades are too tight, I get in trouble. Okay, so I need some dispersion. So I need to throw in some noise. Yeah. Okay. All right. So if no other comments or questions, let me give you a preview what's to come. So we only have, I think, 2 or 3 more weeks of this exchange rate determination stuff, and then we'll go into risk management. So that stuff is assuming you have knowledge of derivatives, and I'm just telling you how derivative pricing is slightly different for foreign currencies. That's it. Okay. So it should be all review if you have background on risk management or derivatives. But if it's new to you, don't worry. I will roughly derive everything for you. Okay. So it shouldn't be. It's okay if you have no background. So this week and next week, this is the last building block of modeling foreign exchange rates. So we want to link one final market in the equations I was given to you already, right? So we have two equations to summarize basically the world, right? One is UIP, that's the uncovered interest rate parity, that just captures the FX market, right? What incentives investors have to come in and clear the market, make the market equilibrate. And you also have the money market, the bonds, the US, the market for interest rates, right? That's the second market. So both of these markets, if you think about it, it's very much related because we're all only talking about financial assets. And one key ingredient that's missing is what's called the real economy, right? The macro economy. And that's what we're trying to do today. We're trying to give you the last piece of the puzzle so that everything is related. The real side as well as the financial side are both important determinants of the current account and therefore the real exchange rate as well as the nominal exchange rate. The real exchange rate as well as the nominal exchange rate. All right, so that's where we're headed. All right, so the last piece of the puzzle. And then we can talk about macro shocks and how that has any sort of impact on spot exchange rate and how central banks and governments can use not only central banks, but now the government can also find a way to influence E, right? So far, the only financial institutions we've been talking about is a central bank. But after introducing to you this final piece of the puzzle, you can also think about tax cuts, government spending, and how that impacts economic output, and how that ultimately impacts exchange rate. You kind of already know where that comes from, right? It comes from Y. So we need to further model the Y variable so that it captures the macroeconomy. Okay. All right. So where does that all fit in? Well, it fits in from the current account equation. So my job today is kind of be very precise in how we're going to model the current account, and then explain to you why Q is not just a ratio of price levels, right, between countries. It's actually a representation of the price of foreign output in terms of domestic output. So in other words, it's a measure of exchange rates of real goods and services, not just price levels of assets, okay? And so let me tell you how that's done, okay? So firstly, I'm going to model the current account a little bit more detail, all right? And I'm going to tell you which parameters are going to be important. So the current account can be represented in the following way. It takes two parameters. So far, I think you've thought of it should only have the parameter Q. That's the real exchange rate. And from the relative price ratio perspective, it's the relative prices that incentivize people to substitute away from domestic for foreign and vice versa, right? But there's also another parameter which we will denote as Y minus T. So Y minus T is is supposed to represent disposable income. Guys, what is it? It's money you keep after paying off your tax liability, right? So I'm a household, I generate some X amount of dollars, but not all of it belongs to me because I can't spend X because I have to pay income tax to live in whatever country. And so after minus tax, that's what I have left over. I can use the rest to save, or I can use it to consume. And from the current account equation, what's primarily important here is if I have residual income, I most likely will use some of that to import goods and services, right? So there's going to be two parameters. One is a consumption parameter, as represented by disposable income. And there's another parameter is incentive to import coming from substitution effect, right? One's an income effect and one's a substitution effect. All right, current account. For the last 6 weeks, we've been focusing primarily on S minus I, right? Total savings minus investments. Starting from this week and maybe next week and the week after that, we're going to be focusing on the commodity side. So the real tangible goods and services side. And so we're going to think about the current account in two parts, EX minus IM, which you already know, okay? Now we're going to parameterize EX and IM in a similar fashion. So we know the current account takes Q and Y minus T, then EX and IM should also take similar parameters. EX here, we have Q. Again, the mechanism should be obvious, right? When foreign prices become higher, then domestic exports is going to increase, right? Because people are substituted away from foreign produced goods and in favor of domestically produced goods. So positive relationship for Q and EX, right? So here I wrote Y star and T star because even though we make more money, it has nothing to do with what we export, right? It's actually the purchasing power or the income generated abroad that could further stimulate exports. So I wrote Y star and T star to represent disposable income of foreign countries. So here should also be pretty clear, right? If it's not a substitution effect, it's going to be an income effect coming from abroad. So if our trading partner becomes wealthier, they have more disposable income, they're going to import more. And as a result, our exports is going to increase. Right? So here, disposable income should also be. So remember, Y star and T star is the star, the asterisk represents foreign countries. All right, IM, similar parameter. But the direction is going to be different now, right? So if foreign prices are higher, then we're less likely to import from them. But here it's still positive, right? Because if we are wealthier, we have more disposable income, we're going to import more. Yes. All right. So based on this equation up to week 6, you probably are thinking about it in terms of just dollars, right? But I'm telling you that you can also think of the current account in terms of what's called output units. So instead of just, dollars, some quantity of money, right? Some nominal unit of money, you can think about it as a unit of price times quantity. So an output unit, right? So this is a little bit abstract, but it all makes sense, okay? So think about the current account exports and imports as domestic output units. So something of price times quantity. It's an abstract way of thinking for now, okay? If you think about it this way, then you can think about Q now in a slightly different manner. So up to week 6, Q has been defined this way. Again, this is intuitive because you're just weighting the E by price ratios between two countries. But I believe I also mentioned that P can also be thought of as a price per unit of something. And I want you to think about P star and P as a price per unit of an output unit that I just said, right? P, price times quantity. So here, if I express price of a price per unit of something, I can do that for P star, and I can do it for P. So P star is price per unit of foreign output, and P is also price per unit of domestic output. So remember, output unit is some abstract representation of price times quantity for a country. Now, after writing it this way, you can just pull those, output units out, right? You'll still get EP star over P, but now this is some number in the numerator, and it's per unit of something, right? So what's important is that we're actually reading Q as some domestic output unit, namely EP star over P units, domestic output units, per 1 unit of foreign output. So Q, therefore, in this way of thinking about it, represents the price of foreign output in terms of domestic output. So it is in the truest sense, right? In the truest sense, a real measure of exchange rate, right? It's in terms of tangible output, right? Real goods and services. It's not a price ratio anymore, right? It's a exchange rate between output units between two countries. So hopefully I didn't lose anybody. So again, this is the equation. So let me summarize again. All I've done is be a little bit more precise of what P star and P is, right? It's still a price ratio, right? You can think of it that way. So far, you shouldn't think of anything else. But I'm telling you, you can now think of P star and P to give it some real dimension by saying it's a price per unit of something. So P star is a price per unit of foreign output, and P is a price per unit of domestic output. All I've done is just divide P star and P per 1 unit of real goods and services for each country, factor out those per unit outputs, and we see that in fact Q is a representation of an exchange rate between real goods per real goods between two countries, right? It's an exchange rate between real asset or real goods or assets or services between two countries, right? All right, I hope that's easy to understand, right? This mathematical representation. All right, why is this important? Well, it's important because now it makes perfect sense why this must be true, right? Domestic import equals the real exchange rate multiplied by EX star. Why? We can see easily why by just writing out the units of both sides. So left-hand side is imports measured in domestic output. So again, it's not dollars anymore. It's not some currency value, right? It's just output units. So you have domestic imports measured by domestic output equal to domestic output units per foreign output units. That's just this ratio here, right? That's E, or sorry, that's Q. Times imports measured in foreign output units. That's EX star. You guys agree? Right? EX star, remember, EX star is exports of other countries. Their exports is our imports, domestic imports, but it's measured not in our units, it's measured in their units, right? That's what EX star is, right? Not prices anymore, it's output units. If you look at this equality, we just cancel out the domestic output units. Sorry, not this side. You look at the right-hand side, you see foreign output units here, foreign outputs unit here. So this is the denominator, this is the numerator. These cancel out. So all we're left is domestic output units. So these two, IM must be equal to Q times EX star, right? In the real sense. So let me say that again. My proposal is that this conversion, this replacement of IM with Q times EX star makes sense if you interpret Q as an exchange rate between goods and services between two countries. So it's no longer a price ratio, right? That's scaling the E. It's now an exchange rate between real goods to real goods between two countries. If you interpret it that way, then IM must be equal to Q times EX star. And the reason why is because IM is measured in domestic output units, and EX star is imports measured in foreign units, and Q is the conversion rate between foreign to domestic, right? The foreign units go away because numerator times denominator, they cancel out. And so all you're left with is domestic output, right? So yes, that's it. So once you're convinced this must be true, we just replace IM with EX star here. And the final equation is this, okay? So I've omitted the Y minus T because we're not so much concerned with disposable income because we think it's trivial compared to the impact of Q, okay? But you can think of it as still there. But we're writing it this way because we're going to take the derivative of the current account with respect to Q, but not with respect to domestic, with disposable income, okay? All right, so far so good, right? Did I lose anybody? All right, so with this equation, we can now do some calculus to really characterize what the volume effect is and what the value effect is. Yes. So all right, let's do this. Let's do our starting point here. Okay. So this these are our assumptions, but this one we can apply some conditions. So we want to say ultimately, define the conditions that allow us to conclude that changes in Q will ultimately lead to an increase in the current account. In other words, more likely that your country is going to export, right? That's what we want to say. What are the conditions that allow us to assume that increases in Q will lead to an increase in CA? So let's go ahead and do that. Right? We know exactly what CA is. It's EX minus Q times EX star. And we can go ahead and take the derivative of the current account, parameterized with Q, with respect to Q. So we're just applying the product rule. So I hope you've seen this, you know this, otherwise it's okay, you can just memorize. So EX is a parameter of Q, so we have derivative of EX with respect to Q minus, it's a minus because it's minus here, Q times, this is the product rule, so Q times the derivative of EX star with respect to Q, and then the derivative of Q with respect to Q with is just 1. Okay, so that's why it's just plus EX star. And then we rearrange terms. So we put all the trade flow effect in one parentheses, and the other parameters and then the other side, right? So where are the trade flow parameters? They're the sensitivities of export with respect to Q, right? These are these terms with derivative terms, right? And everything else is EX star. Everything else is just EX star. All right, so let's think about the signs of each of these parameters. So the derivative of EX with respect to Q should be obvious because let's walk through the logic. Higher foreign prices means that people will substitute away from foreign goods and services in favor of domestic goods and services. So higher Q means higher domestic exports. So this should be positive. Agree? Q itself should also be positive. Yes, because it's E is nominal. Hopefully it's clear that prices should be positive, right? There's no such thing as negative prices or zero prices. Yeah. All right. Q is positive. The derivative of EX star with respect to Q. Okay, so let's walk this through. Higher foreign goods and higher foreign prices means that foreigners will actually try to import, right, from other people, and that means that we're going to import less from them, and our import is their export, so this is going to be negative, right? This term. Right, because higher Q means we're curtailing our imports. That means their exports is going down. Yeah. So a minus sign with another minus sign is therefore positive, right? So everything in this parentheses is positive. So so we have a name for this term, right? These terms in the volume, these terms in parentheses. It's going to be called the volume effect. Why? Because we're talking about trade flows, right? We're talking about exports and imports, right? This is literal movement of goods and services between two countries, or exchange between two countries, and therefore it has the name volume effect. Concur? All right. Last part is just minus EX star. So exports, imports, there's no such thing as negative exports, so EX star is positive, so the minus sign with a positive number is going to be a negative. So this is a negative number. So based on this expression, we have conflicting effects, right? We have one that's always positive and another effect that's always negative. And we need to derive a condition in which this is always positive. And later in class, we will come up with something called the Marshall-Lerner condition, which we have to impose to get this relationship between Q and CA, this positive relationship between Q and CA. Okay. Again, this is called the value effect because it's representing the nominal price levels of foreign goods. So just think about this. If if cell phones in China just have sudden rise in prices, then cell phones overall are more valuable in China relative to every other country, right? So that's going to undermine the current account intuitively, because it seems like commodity prices are worth more in China for some reason, right? So that's undermining your current account. So what's the intuition here? Well, the reason why this is important, understanding this is important, because sometimes we analyze things in the very, very short run versus the medium to long run. So in the very short run, we won't see trade volumes changing much. So perhaps within 1 to 3 months, things don't change as much given a shock to Q. That's because people have very, very long-term relationships with their suppliers. And in that scenario, you're unlikely to change your orders in a very short run. But perhaps within a year, trade will start flowing, trade quantities will start moving, and the volume effect will get much larger than the value effect. So as I will show you for a particular country, what happens when you have a exchange rate shock, let's just say a irrational change in the exchange rate, you'll see that the current account value will dip in the very short term and then go back up. So this is called the J curve. And I'll show you a picture of that, not this week, I think next week. But that's the idea. If you analyze things in the very short run, the current account, the positive relationship between the current account and real exchange rate will break down. It will actually go the opposite direction. The reason because international trade doesn't move that fast. Okay. And you can't do this kind of analysis in those scenarios. How does Q impact the current account? Yeah. Okay. So hopefully that makes things super clear now, right? You understand what the current account represents, two sides, right? Total savings minus investments. We focused on that last 6 weeks. Starting from today, you have a new equation for the current account. It's EX minus Q times EX star. And if you want to know its sensitivity to changes in Q, we can derive it. It's derived right here. This is the equation. And based on this equation, we can impose some conditions to figure out what needs to be true in order for there to be a positive relationship between Q and CA. And in most cases, we will assume that Q has a positive relation with CA, but there are conditions we need to impose. And I'll give you some intuition on what that condition suggests, okay, or implies. All right, comments, questions on now the expanded definition of the current account. You know how to think about the current account, not only in terms of price ratios, but also now the current account, the real exchange rate is also a literal exchange rate between goods between countries, right? Output units of one country versus output units of another country. In addition, it's also a comparison between price ratios between two countries too. Okay. All right, so if no other questions, then I will start today's lecture on flexible exchange rates and output in the short term. So let me clarify why the word flexible is in the title. So it's called flexible because we're going to assume that we're in a world in which nobody pegs the currencies to anything else. So nobody is doing gold standard. Nobody is backing their currency to something else. Nobody has fixed exchange rates like Hong Kong. We're just talking about everybody having floating rates against other currencies, right? Everyone's floating against everybody else. Everybody has monetary policy. They can change money supply at will. There's no benchmark that they have to hit. There's no inflation targeting, none of that, okay? So we're in a very, very flexible world, right? Adaptive world. And we want to relate this kind of exchange rate regime with output. Okay, so we want to now parameterize output somehow. And we already know where that comes from, right? It comes from the L, liquidity demand function, right? Liquidity preference function. All right, so that's our objective today, to parameterize, to add more structure to how Y is determined. Yep. That's exactly what I wrote here, right? Determinants of aggregate demand. So another way of saying that is Y. Okay. Okay. All right, so far, what have we done? We've linked exchange rates with nominal interest rates. So we have R and R star already covered, and we obviously have E, and we have P and P star. The last piece of the puzzle now, as I already said, is output, right? And by now focusing on Y, keep this in the back of your head, we can now think about how the role of government, right? So how does government impact exchange rates, right? And that's something also that you can think about. So up till now, we focused on this, right? As I said already, total savings minus investments. But now we want to focus on the real side, which we have actually talked about a little already, right? We now are going to work with CA equals EXQ, so just EX minus Q times EX star. So our ultimate objective, just graphically thinking, is to now think about E versus phi. Okay, so that's where we're heading. So comparison with last 6 weeks, we were looking at R, right? R versus E. Now we want to have E on the y-axis and Y on the x-axis, okay? And that's going to require some more macro assumptions that may be a bit controversial for some of you who don't like Keynesian stuff, okay? But this is the standard. Okay? This is the standard that you see in the CFA textbooks and so forth. We're going to model Y with what's called the Keynesian model of aggregate demand. In a nutshell, let me give you an idea let me just tell you in one sentence what it's saying. The Keynesian model of aggregate demand basically just says that demand creates supply. So what does that mean? It means that in the overall economy, if I want something, then eventually in equilibrium, somebody will find a way to make it for me. Okay. This is obviously has several implications about the mechanism of how, I guess, firms are created and so forth, but we're not so concerned about the precise way things are, precise ways that things actually occur in reality. We use this kind of shortcut to get a result that resembles reality, okay, to make our lives easier. Because in macro reality, the macro economy is super, super complicated. And what economists do is they use clever tricks to kind of take shortcuts to represent the economy. And this is one way to do it. Okay. We make oversimplifying assumptions that are a bit clever, but ultimately imprecise about reality. All right. So just to give you a heads up for those of you who are who is aware of the debate, okay, and the controversy. But anyways, we're going to think about aggregate demand, in which, as I said, supply is going to be created to meet our demand. And that's how our real economy gets equilibrium, right? So remember, in equilibrium, one thing has to happen. Supply must equal demand, right? Just like the money market equilibrium, demand for money has to equal the supply of money, right? Or supply of debt or whatever. In the real economy, same thing. All goods and services being produced must be created to meet demand. If there's any sort of surplus or shortage, we're not in equilibrium. If we have a shortage, the supply side have incentives to create more because they'll make more money, they'll hire more people, create more income, until there's no residuals left. If there is a oversupply, then if there is a surplus, then businesses have incentives to cut inventory, slow production, fire people, right, to save money, until again, demand equals supply and vice versa. That's the intuition. All right, so this is borrowing from the ISLM framework. So if you know that, great. If not, it's okay. I mentioned this now because we're going to assume that in this class that I is not, we're going to assume that investments, as I will mention later, I believe as well, investments is not determined by by interest rates. It's not, yeah. We're going to assume that investments is what's called exogenous or externally determined. Okay, it's by assumption. The reason why we make this assumption is because we want to keep our analysis simple in this class, and that's what we're doing. That's the only reason. But if you learn ISLM, you know that domestic investments is a function of interest rates. The intuition is the following, right? If interest rates are higher, then the benchmark to beat is the interest rate, and therefore you'll decrease investments because you can put your money in the higher interest rates, right? So there's a negative relationship between investments and interest rates. But you don't have to know that. Okay, we're just going to assume that investments is not determined by anything. It's just a fixed constant, and if I do change it, it's changed at will, right? Just by assumption. Okay. Yeah, investment I takes as unaffected by short-term moves in R. Yeah. Okay. Aggregate demand, amounts of goods and services demanded by household firms throughout the world. Yeah. So difference between today and the previous weeks, we're focusing on price times quantity as a output unit. So whenever I say income, what I really mean is real income, which I really mean is output. Okay, so yes, I make some dollars, but actually I sustain myself by consuming things, right? So think about consuming quantity units of output, right? So I'm being paid in output as opposed to paying in income, right? That's ultimately, we are people, we need to consume things. I can't consume money, right? Some money is made from like things you can eat, but assume that it's not, okay? So that's something to change. We're thinking about real goods and services as output. I'm being paid in real terms, meaning in output units. So when I say aggregate demand, I can also mean real income, or another way of saying is output. They all mean the same thing. Real income, output, aggregate demand. Okay. Why is that the case? Well, I'm only producing as much as I demand, right? So if I demand more, economy produces more, people make more money, etc. Right? So output, aggregate demand, real income, basically saying the same thing. All right, what are the components of aggregate demand? So we already know this, right? We already know what that is. So now just interpret Y, which is our variable as a designation for GMP, right, or GNI. It's C plus I plus G plus EX minus IM, right? So same thing here, right? It's the same parameters: consumption, investments, government demand, and current account, which makes sense, right? So just again, thinking about of goods and services, consumption, yes. I consume things, I can only consume things with output units. So I consume output. So if whatever I consume is gonna be a factor in my total output, right? I can only consume what I produce. So C is there. Investment demand. So if I'm a company and I want to build something, but that requires me to have certain equipment, right? I expect somebody to produce it so that I can buy it with real goods and services and then produce more goods and services, right? So that's also going to be a function for aggregate demand, right? So I demand machines, then somebody has to make the machines. So that's going to be part of total output of country. Yeah. And lastly, government demand. So same thing. If they demand machines, they demand tanks now, right? People are making tanks for Ukraine and Israel now, right? That's also part of your country's output, total output. Yeah. So I consume what I produce. If I'm a company, if I want to make investments that takes real goods and services as an input, that's also part of output. And if the government actually consumes certain things or produces certain things and needs certain outputs, then that's also part of my aggregate demand. So C plus I plus G. Yes. And then the current account. The current account is net foreign demand. So if other countries demand goods and services, you need to produce to satisfy that demand too, right? So they also have C plus I plus G, but you're lending it to them, right? If it's positive, CA is positive. Does that intuition make sense? So to summarize, terminology, that's a little bit different than before. Instead of thinking about dollars, yuan, whatever, Japanese yen, nominal values, we're thinking about real goods and services output units. So when I say aggregate demand, I also mean output. I also mean real income. Okay, they mean the same thing. What are the determinants of aggregate demand or output? Well, it's just like the GNI or GNP equation. C plus I plus G plus EX minus IM. Why? Because consumption, you consume what you produce. So it's going to be a function of aggregate demand. Investments, you need something as an input. You need someone to make something for you. So that whatever being made as an input also is part of output. Government demand, okay, they need examples, they need tanks. Somebody needs to make the components for those tanks. Those inputs must be also a function of aggregate demand. And lastly, the demand of our output from other countries, which is captured by CA, right? That's EX minus IM, right? That's literal commodities, right? Okay, questions, comments on this new way of seeing things. So everything is seen in goods and services, no longer in dollars or nominal terms. All right, so the first bullet point, we've already seen before, right, in the review slides. We have YD, D for disposable income, which is whatever's left over after you're paying off your tax liability. And we're making this designation because this disposable income is what parameterizes consumption. So now our objective is trying to think about what certain determinants or factors will affect C, I, and G. So I, you don't have to worry. Okay, I already said that I in the ISLM model is a function of R, but you can just say it's a constant. It's something we change at will. It's not related to any other parameters. For consumption, it's going to be a function of our disposable income, right? Because the wealthier we are in real terms, the more things we want to consume, right? You can trade your output for, you can consume more because you're wealthier today. Yes, because you don't have to save as much. All right. So one thing to point out is if we don't have a country of savers, any savers, then changing 1 unit of Y will actually lead to 1 unit change of C, right? Assuming nobody saves, right? If nobody saves in the country and everyone just suddenly got wealthier, more productive, then changing 1 unit of Y will lead to 1 unit change in consumption. Yes. So that's a very strong assumption. And so what we will say throughout this class and what you'll see in the graphs as well, is that we're going to assume that there's not a one-to-one relationship between C and Y because people will save. And so when people get wealthier, some of that money is going to be allocated somewhere else, not consumed. All right. And therefore, consumption will have a dampened, will be dampened, okay, relative to change in Y. And this will show up somewhere in the soon. Okay, I'll show you soon. And then for G and for I, we're just going to assume that they are not related to anything. So here I just use a bar here to indicate that it's a constant. You can also say the same thing for G, okay? G is autonomous, meaning that it's determined externally. I as the modeler get to decide what that term is. It's not a function of anything else. All right, so far so good. Comments, questions? So, as I mentioned earlier, our current account that we focus on is going to be expressed in the following way. It is equal to EX minus IM, and you can think of it as quantity units of output, okay? And just like in the review slides, the current account is going to take two parameters. It's going to take Q and disposable income, as I explained earlier. The relationship between Q and CA is ambiguous, right? We learned just a couple of slides in the review slides that Q is actually ambiguous, right? You need to impose some assumptions, and we know precisely what that condition has to be, right? And second parameter is disposable income. The logic should be obvious, right? If you're wealthier, you're going to import, and that's going to undermine your current account value. So making this larger is going to have a negative effect on Q. Right, that's exactly this sentence here. Higher domestic income results in higher spending on imports. So this ambiguity, just to review, depends on whether the volume effect dominates the value effect. Right. So for the analysis for today, let's just assume for today, we can assume that CA and Q have a positive relationship. All right, so this slide is just, again, a review of the review slides. What we're doing, again, is we're taking this equation, now expanding it by replacing IM with Q times EX star. So that's this part here, right? And this should be clear, right? Again, think about Q as just relative price ratio. If foreign goods becomes more expensive, then domestic exports is going to be relatively favorable compared to foreign goods and services. And EX star is going to go down because even foreigners will substitute away from their own goods in favor of our goods. So therefore, EX is positively related and EX star is negatively related. We're going to assume today that Q depreciation, meaning if it increases, then CA will be positive. The ambiguity comes from the fact that the IM has two components, right? It has the flow component and a value component. The flow component obviously is positive because, as you saw, right, in here, it's a minus minus, so it's positive. But there's a value component that's always negative. And that's where the ambiguity comes. And we're just going to assume that's negligible. And so the total effect of Q on CA is positive. All right, so for those of you who don't have the math, here is the text, okay? Just to give you intuition, what the volume and value effect is. So remind you, this is dEx over dQ minus Q times dEx star over dQ. Positive, so that's the volume effect. And the value effect is just minus EX star. So I don't know how much calculus. So maybe everything I said in the beginning of class went over people's head, but just to give you intuition and just economic reasons why what I'm explaining, this is it, okay? So volume effect, as the real exchange rate depreciates, domestic products become relatively less expensive. So again, it's the price ratios that's creating incentives to substitute. So this is the good service substitution effect, right? When there's prices that are now different than before, if one good over the other good from different countries are either more expensive or less expensive, then there's incentive to substitute away or towards something, right? In the case in which Q increases, where foreign goods and services become more expensive, what happens is domestic exports increase, right? Because foreigners want to import our goods because their goods are expensive now, and we want to curtail our imports from abroad in favor of our own, and as a result, our current account increases, right? And for both reasons. So the value effect is just the idea that goods, service become more valuable, more or less valuable. So in the immediate short term, contracted quantities of exports do not respond. So another way, what this means is that assume that dEx dQ is approximately equal to 0, right? If we assume that the sensitivity to export is 0, right? No trade flows, then the only effect that dominates or is apparent is EX star. And if that's the case, then Q will have a negative impact on the current account. So as the real exchange rate depreciates, the relative value of a given quantity of domestic exports. So this is a price times quantity unit, not just price. Equivalently for foreign and relative value of given quantities of their exports, EX star increases. Yeah. So it's the relative value between goods and services that's changed. And that's why there's a negative effect. So intuition, which I think is most important. So let me summarize intuition. Intuition. Volume effect requires that international trade actually takes place. So there's actually movement of commodities between two countries. if trade actually flows to and from, then volume effect will have an impact on CA. Yes, that's what the math tells us, right? The sensitivity of EX with respect to Q, right? That's what EX, the EX, the DEX and the DEX star, right? That's D means the infinitesimal change in EX when you change Q infinitesimally, the sensitivity, right? If the sensitivity of export between countries is zero, oh, sorry, it's non-zero, then there is a volume effect. The value effect is when if the value effect is most prominent if these sensitivities are essentially equal to zero. And the intuition I proposed earlier was that you have to assume we're analyzing the shock in Q in the very, very short run, right? In like 1 month, even days, okay, even days. But mostly it's within, I think, 3 to 6 months, right? You'll see actually a negative effect on the current account. All right, so the last few slides was just a review of the review slides. I believe we have all the ingredients we want, right? We have our definition of aggregate demand, which I need to show you how that's determined, how that equilibrates. And we have the financial markets as represented by FX, UIP to represent the FX markets, and the money market to represents the bond market, right? The market for interest rates. And what we're going to do now is try to combine all these equations into just 2 equations, okay? The financial markets is going to be represented by what's called the AA schedule. All right, so you might ask me what a schedule means. So schedule is like a collection of points, parameters, in which a certain market is in equilibrium. So as you know, right, from the analysis, from doing the E versus R and the money market, right? There's a collection of points along the UIP curve that represents stable or equilibrium conditions, right? These are conditions in which every point on the UIP curve represents a scenario combination between R and E in which carry traders don't have incentive to come in and conduct carry trade, right? It's called a schedule because again, we're talking about collection of points in which either market clears or carry traders have no incentive to come and do anything, right? So the AA schedule is called AA because we want a combination of equations that somehow represents the asset markets. So the asset here is FX market and financial instruments in which we can derive interest rates for, right? That's government securities. So AA schedule represents market clearing for those 2 markets. So we're just going to combine these equations, I'll show you soon, into one single equation, okay? And we're going to plot it against E versus Y. That's our objective. The DD schedule is our collection of points for E and Y in which real money, real goods and services supplied equals real goods and services demanded. And I need to spend some time to talk about how the real economy clears. Okay, gotta put this. All right, so for now, we're going to assume that there's a positive volume effect of Q on CA. So you can assume that DCA, DQ is positive. And we're going to combine all the components we parameterized in the last few slides together into the following equation. It should be linear because we're just adding total output, right? We're just literally adding up, the numbers of units being consumed and produced, right? We have consumption, we have investments, we have government spending, and then we have output demanded by other countries, right? Consumption is primarily determined based on disposable income. Again, the idea here is if you have more income, you're less likely to save and you're going to consume more today, right? So that's a positive. I represents investments. We're assuming I is going to be autonomous, meaning that it's not a function of anything. G is also autonomous, not a function of anything. And the current account, which we talked about at length, parameterized with two parameters, Q, real exchange rate, and Y minus T. So based on this bullet point, we're going to assume that Q is positive related with the current account, and disposable income is going to be negative, right? Because the wealthier you are, you're not going to save as much. You're going to use that extra output to import, right? Buy that handbag, whatever. And that's going to undermine the current account. Cool. So that's going to be equal to D, demand, right? It should be clear. It's D, right? So D represents total demand. Demand from what we consume, right? We consume what we produce. Investments, if we demand certain thing that needs to be created, that's also part of demand. Government may demand things to be created, that's part of demand. And then demand abroad, represented by CA. Okay, so to make our lives easier, we're not going to keep writing all this out, right? Let's just take the most important parameters and just parameterize D as a function. So this is just a shorthand to make our lives easier, or at least my life easier. So we're not going to write CIG and CA out every time. We're just going to say that, okay, it just takes the key ingredients, which is disposable income, I, G, and Q. Right? That's here. So what you should notice here is that disposable income appears twice, right? It's positive here, it's negative here. To make our lives easier, we're just going to assume that disposable income is going to impact consumption more than the negative effect coming from imports, which is empirically more or less true, unless you live in like very, very small countries where that doesn't produce anything. Okay. So most developed nations, large countries, let's say a couple 10 million people, right? Definitely you have a diverse enough industry that manufactures things locally. And if you get an income shock, you're most likely buy things locally as opposed to importing things. Okay. All right. So to summarize, disposable income, positive, right? Investments, positive, G, positive, and Q, positive. Comments, questions? So I think, so I'm going to write this down just to make sure I don't get confused questions. So notice that disposable income Y minus T appears twice and has opposite effects. We are assuming that the effect on consumption prompts import effects. So the net effect is positive. All right, comments, questions on parameterizing aggregate demand function. So I'll give you some intuition, and then I'll talk about market clearing in the real economy after the break. All right, so intuition. Increasing Q raises the current account and therefore D. right? And there's many ways to think about why that's true. You can think about in terms of prices. So if you have a depreciation of Q, it means foreign goods and services become more expensive. And that's gonna help your current account, right? More exports. You can also think about in terms of spending in terms of domestic goods. So if you have a depreciation of Q, then it's going to shift both domestic and foreign spending towards domestic goods. That's another way to think about it. And also it's going to ultimately raise aggregate demand, the final effect for home output, right? So ultimately, because people are moving away from foreign goods, you're going to be producing more, which means that in equilibrium, more is going to be produced from the country. So remember, the Keynesian model is demand creates supply. So if we demand it, then it will be supplied. So we can go through the similar logic for the second bullet point here. A decrease in Q reduces CA and D. So we can go through the same bullet points again. Appreciation. And appreciation of Q makes foreign goods services cheaper. And appreciation of Q shifts both domestic and foreign spending towards foreign goods, and an appreciation of Q lowers aggregate demand for home output. So I need to show you what that looks like graphically, and then explain how market clears, which I'll do that after the break. Okay. Comments, questions on parameterizing aggregate demand. So maybe I summarize a little bit. So big picture, based on the equation that we have at hand, right? We have money market equilibrium, we have UIP summarized by our financial assets, but we realize that the money market has a parameter Y that needs further structure, right? Further clarification. The Y represents real income. And we learned based on this Keynesian model as a preview, this Y can be thought of as also output of an economy. But you have to think of everything in terms of real terms. In other words, physical goods and services. And what we did today is think about what contributes to total output. And we thought about, well, we can just repurpose the GNI or GNP equation and just think about output demanded by a country, right? That's consumption. You consume what you produce. Investments, if you need inputs, you need someone to create it. That's also demand. Government spending, government may also demand certain things, and demand abroad. They also have C plus I plus G, right? And we thought about how each of those parameters depend on disposable income and Q, right? And then we kind of reduced our aggregate demand function into the following equation, right? So this is what we're going to be working with. But just realize that behind the scenes, we have this, okay? But to make our lives easier, we're just going to work with that. And with that in hand, we're ultimately going to try to create two sets of so-called schedules. Again, schedule means that it's a collection of points in which the market clears for certain parameters. So for AA schedule, it's a collection of E's and R's, right? That allows markets to clear. And for the real economy, we have Y's and E's. And when we have complete equilibrium, we must have the same parameters that overlap, right? AA and DD schedule. And that's what we want to show. We want to show that these two schedules cross at a certain point. And precisely at that cross or intersection is where we get complete market clearing. Not only in the financial markets, but also in the real economy. Okay, I'll talk about the mechanism of after the break. I have a quiz for you, so I'll hand that out. Sorry, no, two exams, but you shouldn't think of it as an exam. You can submit it after class, okay, at the end of class. Oh, sorry. Yeah. Oh. Yeah. Good depreciation, meaning that, yeah, good increase. So, it doesn't matter. It could be price increase, it could be foreign price increases, it could be domestic price increases. The whole point is, as long as Q increases, then they're gonna have a positive effect on the currency. Okay, okay. I'm thinking about Q in the same sense as E. So when I say E, when I say there's a depreciation in the domestic currency, I think that E is increasing. So if I say the real exchange rate is depreciating, I'm saying that Q is increasing. So I'm using the word depreciation in the same sense as I'm using for. So Q can change in the direction just like E changes. Yes. So when I say that the real exchange rate depreciates, then it means the same as Q depreciation. Oh, yes. So Q literally, Q is defined in class as the real exchange rate. It's called the real exchange rate for two reasons, right? One is because it's the price ratio. The other reason is because you think about it as in terms of output, price of foreign output in terms of domestic output. So it's a real goods and services variable. So, but the purchasing power, I'm characterizing the strength of the domestic purchasing power using appreciation the same way as E. Makes sense? So if domestic currency gets stronger, then E is decreasing. And I say, yeah, E decreases means that, no, this must, well, you did well on the exam. Well, everybody did well on the exam. So E decreases means that the price of foreign currency is less expensive. Yes. So that means domestic currency is appreciating. So I'm using the same terminology in Q because it's also an exchange rate. So and the purchasing power of domestic currency in terms of real goods and services applies the same logic, right? Q decreasing means it costs fewer domestic output units to buy a single foreign item. Yeah. It's the same idea. That's all I mean. So, yeah.